Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome back to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, welcome. You're in for a cracking episode. Today, we are looking at why the stock market is so predictable long term. We have Pimp My Portfolio with Luke Laretive, and we are back with Book Club. To chat through it, as always, is my equity buddy, Ren. How are you?
I'm good, Bryce. Very excited. A lot to cover in this episode. I think particularly this first segment around how predictable the stock market becomes is counterintuitive, I think, to a lot of people.
Yeah, so one of the biggest challenges that the community told us they have when it comes to investing in our community survey is the idea that the stock market is risky. So we wanted to pull the numbers from one of the books we've written, Don't Stress, Just Invest, to illustrate how the stock market is not risky, especially as you look over a long period of time.
Now, I think we should be very clear and probably also adhere to our licensing conditions and say the stock market
involves risk.
Can be risky. I think, like with a lot of things in life, it's how you approach it and how you play it. And the stock market can be a casino. You can punt and you can lose all your money. On Monday's episode, we spoke about how companies die and indexes are forever. And one of the stats out of that is that 78% of companies listed between 1950 and 2009 went bankrupt. There is no doubt that there is risk. But when you look at the stock market as a whole, and when you look at investing in an index rather than individual companies, the risk changes. And it walks like a duck and it quacks like a duck. You know, like an index fund and a company both are listed on the stock market. Their prices both move when the market's open. They both have stock tickers. They look and sound and act very similar. But from a risk point of view, they are fundamentally different products. And that becomes clearer and clearer the longer you extend your time horizon.
Well, let's put some numbers to it. So we've pulled the S&P 500 annual growth rate with dividends reinvested for every decade, 10-year increment. And we've also done the same for the Australian All Ordinaries Index, because what we want to show is that if you're looking in 10-year increments, 20-year increments, and 30-year increments, the return profiles and I guess the volatility and risk changes favourably, well, in our view anyway. So if we look at from 1900 to 2010 in 10-year increments, so every 10 years, 1900, 1910, 1920, you get it, the average annual growth varies from between negative 0.6% over a 10-year period all the way up to almost 19%. So huge variance. Yeah,
so if people are getting lost in that explanation, it's like different decades have had wildly different outcomes for investors. And as you said, in the 1950s, the average annual growth rate was 18.7%.
Epic.
So like for that decade for investors, they made money. They made so much money. But then in the 2000s, because of the tech bubble bursting and then 9/11 and then the GFC, it was a shocking decade for investors. And the average annual growth rate was minus 0.6%. So if you look at the market in 10-year increments, the outcomes vary wildly. Things start to change as you zoom out. Over 20 years, there was still some variation. But if we get to 30 years and you look at the US market in 30-year increments, between 1900 and 1930, the average annual growth rate was 9.9%. For the next 30 years, 9%. For the next 30 years, 10.1%. For the next 30 years, 10.1%. Things start to revert to the mean and get very
consistent,
yeah.
So that's the S&P 500. The story is eerily similar for the Australian All Ordinaries Index. If you're looking at it 10-year increments, it varies from anywhere. Well, it actually does a lot better than the S&P 500.
The Aussie market's been a goer, yeah.
The lowest annual growth rate over the last 100 years has been about 8%. Wow.
No. So it's not the lowest annual growth rate because there's still been shocking years in there.
Yeah. Over a 10-year period.
Over these 10-year periods, yeah.
And that then comes up to about 18% as well. So for the 30 years from 1900, it was about 13%. For the 30 years from 1930, it was 12%. The next 30 years was about 13%, and then the next 30 was 9%. So again, the volatility, the consistency of it really starts to play out, which is why we stress time and time again the value of being in the market.
Yeah. Now, I know we're throwing a lot of numbers, and the podcast may not be audio. It's hard to convey numbers. And I guess what we say to that is we actually did write it down in a book that's available in all good bookstores. It's called Don't Stress, Just Invest. But I'm going to throw a couple more numbers because we looked at 30-year increments next to each other. We didn't look at overlapping 30-year increments. We looked at 1900 to 1930, then 1930 to 1960. But does this play out in every 30-year window? What if we look at overlapping 30-year windows? So 1900 to 1930, and then 1910 to 1940, 1920 to 1950. So the periods overlap. I've got good news for you, Bryce. It works in every overlapping period, and I'm going to just read the list. So in Australia, starting in 1900, each of these numbers will be one of the overlapping 30-year periods. 13%, 12%, 12%, 12%, 13%, 13%, 13%, 12%, 12%, 9%. Pretty consistent. How about in the US? Let's do the same thing again. So starting in 1900 and going all the way to 2020, each overlapping 30-year period. So starting with 1900 to 1930, then 1910 to 1940. How does it go? 10%, 7%, 8%, 9%, 12%, 11%, 10%, 14%, 11%, 10%. You start to see just how consistent the market has been over the long term.
Yes.
And that's why we say, when in doubt, zoom out. That's why we say the magic of compounding takes time. That's why we say think long term. Now, the final wrinkle, Bryce, is inflation. Because the question is, sure, those growth numbers might be great, but does it consistently beat inflation? So let's do the same thing. Let's do these overlapping 30-year periods and ask, does it beat inflation? So
this is adjusted for inflation. We couldn't get inflation data pre-1930 for Australia, so we'll start from the 1930s. So we've got 8%, 8%, 6%, 6%, 5%, 8%, 7% or thereabouts.
Above inflation.
Above inflation. The story in the US is 7%, 5, 7, 7, 8, 7, 5, 8, 7, 7. So yes, consistently beating inflation and consistently consistent.
Yeah. So that's a lot of numbers. We did this work for the book, and it's pretty amazing what you pull out when you calculate it. So we wanted to bring it to life as best we could on the podcast, because it is just such a reminder why long-term investing is so powerful, and it's such a reminder why people's idea of risk needs to be more nuanced, because the stock market changes depending on how you approach it and what you invest in and for how long you invest in it. And that this is why we invest in market indexes long term. We also enjoy dabbling in some stock picking. We'll get to that. But this is why the core of our portfolio are these long-term indexes, because these numbers just keep bearing it out.
This is Pimp My Portfolio. Pimp My Portfolio.
Easily my favourite sting, and fast becoming my favourite segment here at Equity Mates in 2024. Pimp My Portfolio, where we get an expert to look at the portfolios of the Equity Mates community. We've got Luke Laretive in the studio with us. Luke.
Gentlemen, how are you?
Very well. How are you?
Alive.
Nice.
Alive.
We're not going to ask about that. We're not going to ask about that. But looking forward to this segment. Luke is back, and we've got plenty to get through today. And it is our pleasure to welcome into the hot seat Heath from the Equity Mates community, one of the most active members in our Facebook group as well. Cannot wait for this one. Heath, welcome.
Good morning. Thank you, gents.
Now, Heath, I'm going to give a bit of a spiel on your portfolio. Then Luke's going to hit you with what he has named it. So for everyone listening along at home, Heath has a concentrated portfolio of individual stocks. I don't think there is one ETF in here. I'm based on the conversations that you do in the Equity Mates community. You put a fair amount of time into researching these. So I'm looking forward to understanding how that happens. But you've got some big tech names in there: Amazon, Salesforce. You've got some retail, Visa, Ordinate here on the ASX. A mix of US and Aussie stocks. A lot of recognisable names, but no ETFs. So that's what we're looking forward to today. So, Luke.
Down and dirty, boys. Let's go.
What is the name that you've given to Heath's portfolio?
Oh, it's the curse of success.
The curse of success.
Okay. Can't just, okay, all right.
It's probably not a curse, but, I needed a name. I'm running dry on names. My creativity's not very good.
We've done like 3 of these.
I know. I'm battling. I came out of the blocks too hard.
Do you have some context to give to that for Heath to respond to, or?
Yeah, Heath's doing really well. So let's start there. He's made some pretty good dough investing in the markets, and we can get to some context in a minute and give me a bit more of an understanding of how that sort of happened and the process that's gone in behind that. But from someone who's running a concentrated portfolio, like the weights are kind of ballparky right. I don't know about whether the diversification's necessarily there, and that would be my kind of primary concern, I suppose. But I think if we're talking about what's worked, it's about how do we make sure that we don't give back all those gains. It's fine if you're running a portfolio to have high sensitivity to a particular sector or have a particular thematic that you want to leverage and take advantage of, but there is a time when you don't want to do that anymore. I just want to sort of maybe go through some of those sort of things.
So Heath, with that context in mind, how does that sort of feel in terms of your portfolio?
Luke's name is spot on. Curse of success. I've had a bit of luck. Portfolio's doing reasonably well right now. The problem I have is having to remind myself that I'm not Warren Buffett, and this could be as much good luck as good planning, and trying to find that point where, is a stock a hold? Should I be selling and taking a bit of profit? That whole idea of looking for bottom drawer stocks and ignoring when they get a little bit pricey if you've got that long-term conviction, it's a really difficult one to make when you're sitting on healthy returns.
Yeah.
Given how quickly the market can turn.
Mate, you've done it exceptionally well. I had a quick sniff, and if this has been your whole portfolio, which I'm assuming it hasn't been, I'm sure you've sold something over the journey, but you're running a 76% win rate. So
nice.
Yeah, okay. Wow. So now
maybe this is the baby Buffett. Okay.
Maybe, but I'm going to tell you that I can
trust me. Full disclosure, gents. That is the current portfolio holdings. There have been plenty of dogs and losers that are no longer there.
Yeah, okay. But look, even by the by, that level of success in a portfolio isn't what I want to see, right? You want it to be, it's not sustainable to run like that at those kind of rates.
Yep.
So the caution I wanted to give was and you've identified it yourself, Heath, so it's probably not not that insightful, but is the overconfidence that can happen if you happen to time when you decide to start investing, and the kind of stocks you start investing in, which that might be in banks at a certain time, it could be tech stocks, it could be anything, mining. You think that you're a genius because it's been going well for a while, and then you kind of give it all back, the overconfidence type sort of bias. I would just like to temper any of that by saying that I had a look at some of the other fund managers that run what I would call similar strategies to this, pretty focused on tech, pretty concentrated, global focused, developed market focused, playing some of these big themes that are kind of in Heath's portfolio. I liken it to, Munro, Hyperion, Lakehouse Capital. Now I just pulled those 3 off my database,
yep.
But that's 50 over the last 12 months, they've done 51, 63 and 42% respectively. So they've all gone lights out over the last 12 months. Their long-term numbers are like 7 to 13% per annum. So that's where you're going to go, Heath, if you can keep emulating those sort of portfolios and those sort of returns. I'd probably argue you can't, but that's just my opinion. I don't know, maybe you are the second coming of Nick Griffin, but I'm not sure. But all I would say is that, understand where you're at, be stoked, happy with it, and start thinking about not getting out of the market, but just diversifying your gains. That's kind of how I like to get rid of capital gains, is to not get out of the market, but just take away the concentration risk.
Makes sense.
So we want to leave with some, I guess, like actionable insights for Heath to go away and think about. How would you think about doing that? You know, diversifying the portfolio, adding some resilience to it potentially. And Heath, maybe you don't want to. Maybe you want to keep trying your hand. But you know, if you were going to follow what Luke was talking about, how would he go about it?
I would start by thinking about, okay, which of these stocks, I mean, if you're good enough to buy a stock, you need to be good enough to sell it. And that'd be my biggest learning from doing these Pimp My Portfolios with the Equity Mates community over the last couple of weeks, is that everybody's good at buying. Nobody's good at selling, right? And unfortunately, in this business, you've got to be able to do both. And I think figure out, he's probably good enough to do it if he's got here on his own, you know, what price he should be selling some of these stocks at. And if you need help, I'm happy to sit down with you and do this. You know, we can figure something out that works for both of us. But I would just be looking at where I can take some gains, what's looking a bit expensive. What have I got a lot of dough tied up in, and I can still keep exposure, but I can halve my position quite comfortably, or third my position quite comfortably, and start to just reinvest that either in, if you want to stay stocks and global broad-based index ETF, or an active manager who's running a different sort of strategy that's not one of those three that I just mentioned. I would like to see, whether you're great at this, Heath, or you're going to start to sort of bring in experts to help you, I want to see, even in our portfolios, the way that I generate returns, that's great. But we still employ other managers to generate returns the way that they do, that's different to me. Yep. You want to be sort of driving your, essentially making money from a different strategy, different sources at different times, so that you kind of have that proper diversification. So I'd be heading there, particularly if this is a big chunk of Heath's money, which maybe it is, maybe it isn't. But, I'd really like to see some diverse sources of growth and profit here. I'd really like to see some, other styles, some value, some quality. There's other ways you can invest dough. And also probably when the money starts to get a bit more serious for you, some more asset classes, not just equities, and not just global large cap, and then a couple of fundy darling stocks, which, we can talk about my views on WiseTech till the cows come home, Heath, but we'll save that for another day.
Yeah, no. Give us your 60-second or less WiseTech.
Okay, let's not talk about WiseTech specifically. Let's just say Ordinate WiseTech are trading on 60 times earnings, EV to EBITDA, right? Huge multiple. There are businesses that you can buy, I would argue, that might not have the same history of success, but look like they're going to have a future of success that looks something like that. I would say one of the big positions we've got in our portfolio is Webjet. Whilst it hasn't always generated a 30% return on invested capital, we think that it can grow 30% per annum, and probably will get to similar returns on invested capital that WiseTech and Ordinate are on, but it's trading at 15 or 20 times EV to EBITDA.
Heath, have you thought about where to from here with your portfolio? Some of the positions you're up almost 200% on, a lot of double-digit returns on a lot of you, as Luke said, 76% hit rate or whatever it might be. Have you thought about where to go with some of these stocks?
Absolutely. Yeah. I have some investments in property, which I'll be cashing out shortly. And the intent is not to double down on these existing holdings. I do want to try and build something of an actual core portfolio. Mm-hmm. And, so that, of course, just talking about general names and that's looking at things like VDHG, Qual, Moat, maybe VGS, those sort of things. I found it reasonably. I found I've been able to reasonably go against the market when good companies are out of favour. That's when I picked up Ordinate, for example, back in 2022. Mm-hmm. You hit the nail on the head, though. I do struggle to sell when things are going really well. I have that fear of, if I sell it now, am I missing out on decades worth of growth? But realistically, listening to you guys and a lot of the other good, podcasters out there that are talking about all of those, mental models that you can apply and, those individual biases that can hold you back, it helps check yourself. Stop, think about what you're doing and make fewer mistakes than you would otherwise.
I think that's the half the battle is people find companies that they like the story of, and they're buying on the back of a story, and they might do what Heath's done and, you know, wait for the market to fall out of love with it for whatever reason, and, you know, maybe it's an earnings blip or whatever. They see that recovering and they buy really well. I think the selling side is much more difficult because momentum can continue for a long time, and stocks can stay expensive for a long time. I don't think there's been any time in the last 5 or 7 years when I've looked at WiseTech and thought, wow, that's a steal. It always looks expensive because it is kind of a good business.
Yeah, but wasn't that the story about Amazon for 20 years? It looked expensive, but it just kept growing.
Yeah, look, I think
and
you
it's
need
still
to
the story about Pro Medicus.
Yeah, that's a good one, yeah.
It's not the kind of, as I said to you, there's lots of ways to generate returns in the market and lots of styles of investors. Buying stuff on 60 times EV to EBITDA is just not my style as a general comment, unless it owns a category and unless it's a category killer, essentially. You know, there are businesses... Amazon's got 50-something% of retail in the US. It's a category killer. So you need to be able to identify, genuine, global, growing, addressable market and scale and monopoly versus not.
Yeah. Versus a great story.
A good read.
Yeah.
Well, Heath, we have run out of time, so I just want to say, I guess, congrats on such a successful portfolio to date, and a big thank you to the effort and contribution that you make to the Facebook group. You certainly are helping everyone in there learn a bit about the strategies that you put in place. So if you're not part of the community on Facebook, come and join us and join the discussion. So we will leave it there. I hope Luke's been able to give you a few things to think about. I'm sure there's plenty to unpack.
It's a good portfolio. It's good. It's a good one to do. So I'm really stoked with it. Well done, Heath.
Thanks, gents. I really appreciated it.
No worries. If you want to submit to Pimp My Portfolio as well, head to equitymates.com/contact and you can submit your portfolio, or we can connect you with Luke if you'd like to have a one-on-one with him in your own time to get his thoughts. But we'll leave it there.
Thanks, guys.
This is Pimp My Portfolio. Pimp My Portfolio.
All right, well, we're going to take a very quick break, and then on the other side, we're back with Book Club. I hope you've been busy reading this month because we're going to unpack the latest book. We'll be right back. Welcome back to Equity Mates. It's time for...
Book Club. Ren's reading the book, so Bryce doesn't have to.
Perfect. My favourite time of month.
So the book that we read, and by we I don't mean you, I mean we and
the Equity Mates community.
Whoever's reading along with me in the Equity Mates community, was inspired by our interview with Aswath Damodaran.
Yeah.
So we decided to read his book, The Little Book of Valuation. The Little Book is it's like a series of books. There's Joel Greenblatt's book, The Little Book That Beats the Market. I highly recommend that one. But there's 26 of them, all related to investing. Some of them get kind of esoteric is probably the generous term. But there's some good ones in there. So good little series if you want some introductions to key investing concepts. Now, that's what I thought this book would be.
Okay.
It's a little book that beats them. A little book of valuation. I thought it'd be a little
basics,
gentle introduction to some key valuation concepts. Strap your hard hat on, Bryce, because Look, I mean, I think this book oscillates between explaining very simply and clearly some very basic things, and then getting into complex formulas. For example, if you ever want to calculate the appropriate discount rate, I have all the formulas to calculate. Well, first of all, a discount rate in a discounted cash flow is made up of the risk-free rate, the equity risk premium, and then the individual stocks beta. And together we can calculate them all because you get all the formulas in this book.
Wow.
Yeah. Parts of this book, I was
it's a textbook.
Parts of this, I was like, this is why people hate studying finance at uni.
Yeah. Well, can't wait for it. Sounds enthralling.
But if you want to invest in individual stocks and you want to value a company, you have to do it.
Yeah.
It's just it's not as fun as trying to predict
just throwing darts at a dartboard.
What's going to happen next in the news, or seeing Nvidia go from bottom left to top right. So I think conceptually this book's really broken into 4 parts, valuation concepts, then intrinsic value, and that's where a lot of the textbooky stuff is. Then relative value, and then finally how we apply these concepts. So starting with valuation concepts, like there's like why investing works, the time value of money, like some of those basic stuffs. The limitations of valuations. So two big ones from Aswath. All valuations are biased and most valuations are wrong. So I think it's like really tempering you to be generally right rather than specifically wrong when it comes to valuations. He goes through Accounting 101, the different financial statements. Then we get into intrinsic value. This is the dense part of the book, and this is all about discounted cash flows and calculating intrinsic value of a company and arriving at one number. And it's very specific. I was talking about calculating the discount rate before. For example, he steps through an example and calculates that 3M in 2008's appropriate discount rate was 9.16%. Like that's a level of great. So whenever I do a DCF, I just use 10% as my discount rate, and I never calculate the appropriate discount rate. But that's why I asked Swath.
Yeah, Dean of Finance.
But even Buffett said he would use long-term treasuries as his discount rate.
Yeah.
Probably in an era where long-term treasuries weren't paying a couple of points. But yeah. That intrinsic value section is really interesting. It's quite dense. It did put me to sleep a few nights when I was reading it before bed. So good sleep aid if you want it. But it's some of the most complex and difficult to explain investing concepts explained well. Like he, as we heard in the interview, he's good at explaining this stuff. This stuff just is naturally dense and mathematical. Then we get to relative value, and that's all about comparing ratios. That's a lot more simple and conceptually, it's easier to read. Yeah. Some really interesting stuff in there though, and some stuff that I hadn't really thought about. So how's this one that I pulled out and I wanted to bring? When you're looking at a ratio, you need to make sure that the numerator and denominator are defined consistently. If the numerator is an equity value, then the denominator should be an equity value as well. If the numerator is a firm value or an operating value, then the denominator should be as well. And there are some ratios, some that are pretty common, which don't pass that test. So some that do, price to equity. Both are looking at the equity value of the company. EBITDA to enterprise value are both looking at the operating assets of the company. So those both work as ratios. But here's a really common one that does not meet that test. Price to sales. Because price looks at equity value, it looks at the what the company is valued at by the market, whereas sales is an operating value. It's the firm's value. Now, why is this a problem? And conceptually, if none of this made sense, this is the important bit. You have two companies, they have the same amount of sales, but very different levels of debt. That if you just looked at price to sales and they were at a similar price, the ratios would be similar, but they shouldn't be because one company is more valuable than the other. You should be using enterprise value to sales because they're both firm operating values and they factor in that debt. Or you use price to earnings because earnings factors in the cost of debt, like you're paying interest on debt. Make sense?
Yeah, conceptually.
So anyway, there was really interesting stuff like that around both the intrinsic value stuff we spoke about, but then also relative value. So I think however you want to value companies, there's some good stuff in there. So then after it goes through it all conceptually, then it just goes deep on applying these concepts. How to value mature companies, how to value growth. These are all different chapters. How to value growth companies, how to value declining companies, a chapter on financial companies, a chapter on cyclical and commodity companies, a chapter on companies with intangible assets. You get the point. Every company.
Far out.
But look, my overall takeaway from this book is this is a book about getting a good valuation rather than getting a good investment, if that makes sense.
Yeah. Okay.
Yeah. If you read this book hoping to find the secret to finding great investments and great ideas, this isn't the book for you.
But you'll get to a good number.
This is a book for how you value anything.
Yeah.
And how you do it well.
Yeah.
And conceptually why we do it in a certain way. No, but it's almost just a given for him. He's the dean of valuation. He's not the dean of good investment ideas.
But I mean, does he then apply it to, because he's not just going out and buying everything that comes
cheap.
Yeah.
Yeah, no. But like part of, and that, that's when he's talking about the growth companies and stuff, like you have to forecast into the future to get.
True.
Like,
so it's implicit in the number.
Yeah, like a valuation is only as good as the numbers in that valuation, and the numbers in that valuation are only as good as the work you do to forecast what comes next.
Yeah.
Forecasting is incredibly hard.
Yeah.
But, he goes through examples, 3M, Google, Under Armour, Toyota. Like, there's a lot of worked examples throughout the book. But, yeah, it is a book about valuation as opposed to a book about investing, if that slight distinction makes sense.
Yeah, it feels more like a textbook than a...
Oh, no. Like, he's written textbooks. They would be a level denser than this.
True.
I don't want to put it this way. It is probably one of the most accessible books on intrinsic valuation that I've read.
Okay.
Not that I've read a heap, but I've read a few. I've read more than the average person, I would say. Now, look, let me leave you with Aswath's 10 Rules for the Road, which is how he leaves his book. And whether or not you want to read this book, some good stuff about, I guess, like how he uses valuation in his life.
Okay.
1, feel free to abandon models, but do not budge on first principles. Pay heed to markets, but do not let them determine what you do. Risk affects value. Growth is not free and is not always good for value. All good things, including growth, come to an end. Nothing is forever. Watch out for truncation risks. Many firms do not make it. Look at the past, but think about the future. Remember the law of large numbers. An average is better than a single number. Accept uncertainty, face up to it and deal with it. And finally, and I think this is probably most important for our style of investing, convert stories to numbers.
Yeah, he was big on that in the interview.
Yeah.
Every number has a story.
And every story has a number.
Yeah, same thing.
All right,
Nice.
look. All right, so for the next month, the book I'm going to read, it's called Unscripted, The Epic Battle for a Media Empire. The quote is the real life Succession. So,
Oh, nice.
yeah,
Epic.
there you go.
All right. Well, I'm going to watch Succession.
Bit more excitement than Aswath's valuation book.
Nice.
No offense to Aswath.
No offense. Well, if you have a book that you'd like to add to the list as well for our monthly book club, hit us up at equitymates.com/contact. But otherwise, Ren, we'll leave it there and pick it up next episode.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.